Hello everyone, welcome back. In this lecture, we will cover profitability measures. Profitability analysis helps financial analysts and managers or decision makers to evaluate firms' profit with respect to sales, assets, or investment. There are profitability ratios to analyze the profitability of the firm, and income statement is obviously one of the starting point for profitability analysis. However, only net income or operating income is not solely enough to analyze profitability of the firm, because just looking at this figure we cannot say whether the firm is going smoothly or whether the firm has got any sort of trouble in their operation. And this is why we need to apply profitability ratios or other sort of analysis for profitability measures. We can analyze profitability, or we can apply profitability ratios based on the sales of the business. One of the ratio which is based on the sale is gross profit margin. It is simply the percentage of each sales dollar remaining after the firm has paid for its goods. We know that gross profit means sales minus cost of goods sold. So gross profit margin measures what percentage of profit the firm is receiving on its sales after deducting cost of goods sold from the sales. So higher the gross profit margin, the better it is for the firm. Gross profit margin is equal to sales minus cost of goods sold divided by sales, or simply gross profit divided by sales. Here is the gross profit margin of a company. Over here, the gross profit margin of this company in 2012 is 32.1%. Operating profit margin measures firm's profitability on sales after deducting all expenses except interest, taxes, and preferred stock dividends. Operating profit is also known as true profit for the firm because they measure only profit earned on the operation, and operating profits ignore interest, taxes, and preferred stock dividends. So operating profit shows the true profit of the business from the operation. Operating profit margin is equal to operating profits divided by sales. Here is an example of operating profit margin of a company in 2012, which is 13.6% based on the formula. So if we compare the operating profit margin of ABC Incorporation, for example, operating profit margin has decreased substantially from 2018 to 2019. It indicates that firm's operating expenses has increased substantially from 2018 to 2019. Gross profit margin of ABC Incorporation also decreased from 2018 to 2019. It also indicates that firm's cost of goods sold has increased relative to its sales from 2018 to 2019. However, to find out reasons behind this result, financial analysts or managers need to discuss with operating managers or line managers or the owners to identify all the reasons behind these results. Net profit margin measures the percentage of revenue left for the shareholders after all expenses has been paid for. Generally, higher the net profit margin, better it is for the firm. Net profit margin is equal to net income or net income divided by sales. Here is an example of net profit margin, which is 7.2% for this company in 2012. If we compare net profit margin between ABC Incorporation and XYZ Incorporation in 2019, we can see that ABC Incorporation has lower net profit margin than its competitor. So ABC has a scope to improve its operation, or it should take some steps to increase revenues and minimize sales to outperform its competitors. Profitability ratios can be measured based on the investment returns as well, because shareholders would want to know their return on their investment in the firm. One of the ratios to measure return on investment is return on equity, which is simply net income divided by book value of equity. So return on equity is a ratio that reflects return on past investment in the firm. However, there are some problems with this ratio, because return on equity is equal to net income divided by book value of the equity. Net income is a flow measure, whereas book value of equity is a stock measure. Flow measure means firm's income statement is prepared for a particular period from which starts, whereas firm's balance sheet shows its outcome over its lifetime, because assets are built up over the lifetime, equities are built up over the lifetime. So income statement items are flow measure and balance sheet items are stock measure. So it is not a good thing to compare flow measure with stock measure, or simply income statement item with balance sheet item. It's not a good comparison. So it is better to use average book value of equity. So over here it is better to use return on equity as net income divided by average book value of the equity, or simply BV of the equity. To find out average book value of the equity, say for example in 2019, we can take the book value of equity of the financial year 2019, ending book value of equity of the financial year of 2019, and book value of the equity, that means the ending book value of the equity of 2018. Then if we deduct it by 2, we'll get average book value of the equity in 2019. However, past investments do not only consist of equity, it also consists of debt. So analysts often use return on asset, because return on asset is equal to, or simply asset is equal to liabilities plus equity. So asset includes both debt and equity. So to find out investment on return, analysts often use return on asset, which is equal to net income divided by average book value of the assets. We can calculate the average book value of the asset way we showed you to calculate average book value of the equity. So that means the ending book value of the equity of a particular year and ending book value of the equity of the previous year, then divided by book value of the asset of the previous year, then divided by 2. This is why analysts prefer return on asset over return on equity, because return on asset includes both debt and equity. So return on asset means it's the total investment of the firm, and return on asset is not as sensitive to firm's choice of leverage. So here is a comparison of profitability ratios between ABC Incorporation and XYZ Incorporation. Over here we have considered net profit margin, return on equity, and return on asset. If we look at a net profit margin, we can say that XYZ Incorporation has higher net profit margin in both year than ABC Incorporation. Similarly, if we look at return on equity, we can also say that XYZ Corporation has higher return on equity than ABC Corporation in both year. However, if we look at return on asset, over here we can see that return on asset of ABC Incorporation and XYZ Incorporation are almost equal in both years. So based on return on asset, XYZ Corporation is not much better than ABC Corporation, or both firms are equal, and we know that return on asset is a better measure of profitability than return on equity. One of the most popular profitability ratio is earning per share. It represents the number of dollars earned during the period on behalf of each outstanding share of common stock. Earning per share is equal to net income divided by average outstanding number of shares. Here is an example of earning per share of company in 2012. So earning per share of this company is 2.90. The result indicates that against each share, shareholders are receiving $2.900 net income. That's all about this lecture. In our next lecture, we'll cover leverage measures.